Well, hey, Southern Oregon, welcome back to the Real Estate Show. We have a really good one for you today. Guy Giles of Mutual Mortgage is coming into the studio in just a little bit. And that's great news because we've had quite an interesting week just in the last week. Forget about the whole month. So Guy Giles of Mutual Mortgage comes on the show once or twice a month to try to explain how the Federal Reserve Bank is working and how the general mortgage lending markets are going these days. While we're waiting for Guy to join us, let's check in with the local housing statistics for all three of our Southern Oregon counties. Let's start with Jackson County this week. Jackson County prices year over year in the residential market are up 10% this week. The average single family home in Jackson County costing $557,283. The number of solds in Jackson County this week, year over year, are up a whopping 67%. We had 72 closed residential sales in Jackson County this week. The number of listings year over year in Jackson County are also up 11% this week. We have 797 active residential listings on SOMLS in Jackson County. And this week, we're going to start tracking something new. We're going to track back on markets. These are the folks that are losing their buyers or their buyers that are canceling their transactions. So we have back on market in Jackson County this week, 20 in the residential market. Josephine County this week, prices year over year are up 28%. The average single family residential home in Josephine County average is $516,640. The number of sold year over year in Josephine County are also up 27% this week. We had 23 closings in the residential market in Josephine County. The number of listings year over year in Josephine County are up 13%. We now have 377 active residential listings in Josephine County this week. Back on market is 15 in Josephine County this week. And let's finish up with Klamath County. We have our prices in Klamath County year over year are down 23%. The average residential home in Klamath County this week costing $277,775. The number of sold year over year in Klamath County are up 77%. There were 16 closings in the residential market in Klamath County on SOMLS this week. The number of listings in Klamath County are up 26% year over year this week. We now have 289 active listings in Klamath County on SOMLS in the residential market. The number of back on markets in Klamath County this week were 5. So we see an uptick in prices on both Jackson County and Josephine County this week. Klamath County is down. Klamath County usually is one of the ones that's been up lately. But we also have an uptick in all of the county's listing inventory. Thank you, sellers, for putting your homes on the market. We hope to have a really good summer season here in Southern Oregon, in spite of the wild interest rate increases. But, sometimes they do go down. And Guy Giles from Mutual Mortgage is here in the studio to talk to us about some of the interest rate issues and so on. Well, welcome back to the show, Guy. Thanks for coming on.
Hey, I'm glad to be here. Got a lot of information about markets and hopefully where they're going eventually. So I'm
Well,
ready.
it was kind of a dramatic week. We had a lot of reports come out, and where do you want to start?
Well, I guess we could start with what is going on that's going on. I would say but what helps our industry and at least helps our side of things are when rates go lower. And what causes rates to go lower generally is a slowdown in the economy or lower inflation, things like that. So I mean, it's always a little bit of a mixed bag. When I'm excited about low rates, unfortunately, sometimes things are going bad in the markets. But it is what it is, and it's my job to just kind of figure out when's the right time to do things rather than try to affect the news. but we actually started out the week really, really strong. Kind of started last week, and it went into this week also. The first thing was the ADP jobs numbers. They were expecting 175,000 jobs. They only got 152,000 jobs. And these are, I want to kind of make a distinction between real numbers and feelings and guesses, because that's the two things that we're fighting against. You know, like some people talk about like devil on one shoulder and an angel on the other. That's how I feel with a lot of these numbers that come out. You have ADP. These guys are collecting paying people out. So I think they have a really good pulse on.
So they're payroll numbers.
Yeah.
Okay.
Yes. Yeah. So I mean, I don't know what would get more accurate than that. And it showed some weaker numbers, and they revised the numbers down from last month. So that was going really well. A little later in the week, we had, I mean, jobless claims were up, and that is actually showing, you know, in some data that I'll show you, because what happened is everything's been going really well, and then Friday, the headline kind of changed some things.
Mm-hmm.
But actually, Canada and the European unions both lowered rates this week. So that was actually a plus, and there was a lot of us in my business thinking that, well, we would follow just immediately, be, you know, just ready to drop our rates, and maybe not drop them yet, but at least be heading to that direction. And up until Friday, that was really kind of the direction, you know, that we were heading. So if you look at a lot of what we have, you know, going on, that would show weakness. Otherwise, they would not be doing that. So I was really anticipating Friday's BLS jobs report to come out, and when it did, they gained 272,000 jobs, and their estimate was 185,000 jobs. So it came in a lot stronger than what they initially anticipated. Of course, they revised last month down because it's kind of how they do it. They come in with this headline, makes everything sound really good, and then they revise the previous numbers. And it seems to be a pattern that's been going on for a long, long time with these guys. And what hit us the most was what they call the birth death rate. And that's not people, you know, automatically you might think that, but it really has to do with the birth and the death of small businesses. And
they're talking about businesses.
yes, yeah.
Okay.
And so they they came up with this giant number and what they do is they kind of guess how many small businesses started and how many small businesses stopped, and they also guess how many people that they hired. So that's the headlines that kind of threw the bond market and the mortgage-backed securities into, you know, a backslide on Friday. And if you go deeper at all, by the time they reconciled their numbers from last year, because I mentioned a few minutes ago that they come back and then they revise things down, you know, pretty much every month. It's kind of a consistent thing. Last year, if you look at the actual numbers, because at some point, you know, like I said, they're guessing on these numbers. If you look at the actual numbers, that once they had all the data for last year, we lost 800,000 jobs. We didn't gain 800. You know, we didn't make these massive gains like they're saying.
So you know what's so interesting about that is in Southern Oregon, if you post a job right now, you get lots and lots of responses, and that was not the case before. And I was thinking it was just here because, you know, we're kind of a smaller, weaker economy, not being derogatory, but we just don't have like the manufacturing stuff of San Jose or whatever. But
Yeah.
but I wonder if that's going on across the board.
I would think. I mean, you know,
Because it
how
feels
people
like
feel.
the job market is not good, but I thought it was just local. That's all. I didn't mean to interrupt, just chiming
No,
in.
no, I think it's relevant because I mean, it kind of goes to the greater thing where we're told something like these numbers, but everybody on the street even if you don't have the facts to back it up, you feel like something's wrong with what they're saying.
Yeah, yeah,
I
that
don't want to
makes
be
sense.
pessimistic like that. I really pray to God and that people do have everybody's best interest at heart. And
Uh-huh.
I mean, every now and then you make a bad hire, and maybe that's what we did with some of these institutions. And the good news is that people are out looking for a job, so maybe somebody will fill it that'll and just put it's all we want is normal. And right now it's just not feeling like that. And that's not I don't want to get all pessimistic. I mean, overall the last 2 weeks rates are down, and what we lost on Friday with these weird numbers, we're still ahead. And
So we only have about a minute left before we have to go to break, but this is so interesting. About where are the rates this week then? Where have
I'm
they been hovering? Because I know it changes.
Well, depending if it's a government loan or a regular one or FICO score, it's hard to get nailed down on this stuff, but anywhere from the mid low sixes, if you're in really good shape, on a government loan to mid sevens or so. I mean,
Okay.
it's hard to do that without an APR. It's actually illegal for me to do it without an APR.
Well,
So
but we're just kind of talking. We're not
yeah,
qualifying anybody.
I mean, overall, I would say they probably came down about close to 1/4% if you just want
Okay.
to net the whole thing out. So
Okay. Well, let's
that's
hold
not
that
bad.
thought. We're going to talk more about the interest rate up and down with Guy Giles, Mutual Mortgage. We're going to take a quick break. We'll be right back after a word from our sponsors, Guy Giles Mutual Mortgage. Thank you for bringing the show every week. John L. Scott, Ashland and Medford, and our local Rogue Valley Association of Realtors. Don't. Well, hey, real estate fans, welcome back to the Real Estate Show. So glad you could join us today. We are having a really interesting conversation with Guy Giles, Mutual Mortgage, our in-house lender here at the Real Estate Show. And right before the break, we were talking about the interest rate fluctuations again this week. Guy, what's going on?
Oh man, I really thought I had a good handle on it before Friday. I mean, I think what's going on is the overall trend. It's going to go down. It has to go down. I mean, if you just look at the fundamentals, I talked a little bit about the BLS numbers and about their birth death rate, where they're guessing how many people got hired and guessing how many businesses started up. But if you actually go to the household survey, where they're actually calling people and calling businesses and finding out what's going on,
Uh-huh.
we actually had 408,000 less jobs. And
Really?
yeah, yeah. And so if you looked at the total labor force, it was down about 250,000 jobs. So really, it's not quite as strong as what the headline, and I'm really hoping that investors will just dig deeper into these numbers, get away from the headlines, and just you know do what's right for their investors. So
Mm-hmm.
that said, we mentioned, or I mentioned a little while ago, that Canada and the EU both lowered rates this week. So it should be
Now,
a
why is that significant that Canada and the European Union lowered their interest rates and we did not?
well, because we are affected a little bit more, with everybody around the world. We're kind of tied in at this point because all of our economies kind of depend on each other, and if you look at another country that we do a lot of trading with, and there's only a few what we call kind of superpowers, especially when it comes to economies. A recession is a recession, and they're recognizing that it's time to start lowering these rates. If it was not for our job numbers at this point, I do believe that the Fed would be lowering our rates right now. So my hope is that we'll come around and just be a little bit more realistic with what's truly happening with the numbers. And I'm hoping that it won't be long before we kind of follow suit. The unemployment rate did tick up from 3.9 to 4% this last month. So all of the other indicators are showing what these job numbers should show. And I at some point I hope we get away from putting so much attention on almost feelings and guesses, and let's just go back to raw data, even if we have to wait
Yeah.
for a month or two, because they always get revised lower these days. Any-
Yeah. Yeah. It's a moving target, and then you can't really make good decisions
And
if the
I'm not
numbers
saying
are
that,
changing.
yeah, I will never say the Fed has an easy job. I mean, if I've said it in the past, I wish there was still an Alan Greenspan around that would go buy groceries at Walmart and get a real pulse for what's going on. I do feel there's a disconnect in between a bunch of people that are community planners that are now all of a sudden are
Well,
but
in the Greenspan years, and during the hyperinflation of the 70s and 80s, the feds would never ever talk about what they were thinking. They were very close-lipped about everything.
yeah, yeah, I don't know if maybe it's the TikTok nation that we're in at this point.
The digital age.
Yeah, where everybody feels like they need to be heard. But maybe I'm doing the same thing, having to be on the radio. But anyway, I do think that I can't say it enough. What are we up 47% or something like that since 2000 with our home prices? And I'm talking as a country. I actually
Mhm.
did an exercise with the young lady this last week. I won't say her name, but super proud of her. She's fresh out of college, just bought a duplex, and she's going to live in half of it, and she's going to rent out the other side.
Very smart.
And after I go through the good, the bad, the ugly with the numbers, I really like to sit with somebody and say, I don't lead with this because I'm not trying to be salesy, but I want you to know, if things track, even lower than where they are right now, what your house is going to be worth in 10 years. Because it's easy to say, my payment's $2,600 a month.
I Isn't that shocking?
It is, and to be fair, she's getting half that back from the rent on the other side of the place.
Thank
So,
goodness.
she'll have it for a few years, probably get married, turn it into a rental, and then she's going to have passive income for the rest of her life and an appreciating asset. So when I looked at it and I ran the numbers on her $400,000 house, it's going to be worth, 800,000 in 4 years. She just looked me right in the eye and said, "There's no way that's accurate." And I was like, why don't we go back and look at a house that I bought 20 years ago? So I had it through probably the biggest decline ever in housing prices
Oh
after the
yeah, yeah. If
crash
you've had
of
it
'09.
20 years, yeah, the big
So
crash.
so I've had it through that. I've had it through the last few years. I've had it through, through the good.
COVID.
And I ran the exact same calculation, and it actually came out lower than what that house is worth right at this moment. So basically, what I had given her was probably not even as good as she's going to do on that house.
Wow.
I would not like to see houses just keep going up at this pace. I like to use a 4.3, 4.4% because that's probably closer to the average on the last 80 years.
Mm-hmm.
Nothing compared to what's been happening over the last 10 or 15 or 10 anyway.
Yeah. And I feel like we should talk about that a little bit more because they started calling the COVID a run up in housing prices the unicorn years. And I'm kind of glad they sectioned that timeline out of the regular tracking. I mean, they still count it, but they also discount it a little bit.
Mhm.
Because that's not normal. And we just have people that are still out there trying to get really too much for their house in the economic environment that we have today. And I
Yeah.
think that's frustrating buyers a lot. I don't know, do your buyers talk to you about how difficult some of the sellers are? And we're all worried about appraisals.
Yeah, and I haven't really had an issue with appraisals coming in lower. Thankfully, I've been around long enough that I work with more seasoned agents like you that have a realistic expectation on what you can write an offer for and what you can list your house
Yeah,
for.
we have that conversation with people,
Yeah, yeah,
as
it's
unhappy as it is.
I know everybody wants to, but I know I'd rather be told the truth,
Yeah,
um,
yeah.
than run around thinking I got something that I don't have.
Mhm.
So, and I think that's probably what frustrates me so much about a lot of the numbers that come out. It's just like, let's have the truth. I don't know. It doesn't seem too hard, but you're right. And I think that that it's going to add a little bit to that storm. Didn't they, I think they moved you guys up to August now with the new agreements that I'm sure you're probably already doing them
You
with.
know, all the big agencies for sure, the big real estate brokerage companies, they have we're doing it. Like
Yeah.
we're doing it. Yeah.
So we'll probably have another weird little time where you still have the sellers thinking, not really coming to terms with the fact because they have a 2.8% loan on their house that the person buying it is getting, a 7.5% rate or a 7%.
Until somebody tells them what the buyer's payment's going to be. And then there's dead silence.
Yeah.
They haven't, because they're sellers, they haven't taken the time to run the numbers of what the payment's going to be for the buyer of their house, but they're
Yeah.
usually a little more circumspect after they hear 2,600, 3,100.
Yeah. And then you couple that with the fact that they're like, oh God, and on top of that, I don't have to pay a commission to the buyers or the buyer's agent. So
Well, that's a little interesting tangent is we're noticing that the sellers that are not offering the area, because everything's negotiable, there's no price fixing, but plumbers charge about the same, electricians charge about the same, real
yeah,
estate agents charge about the same. That's just kind of the going rate, 2.5. But we're tracking with some of the sellers who are offering less than 2.5, they're not getting the showings. And
yeah,
it's not the agents that are avoiding it, it's the buyers, because the buyers have a contract now with the agent for 2.5, and that means the buyer has to make up the difference.
man.
And so the buyers are instructing their agents, well, I guess, I don't want to go see that house then. Or they're just putting an offer and it says, sellers, you're paying my agent.
Yeah.
So here we go.
Why is it every time we get a bunch of lawyers involved in trying to help the little guy, that the little guy gets hurt? I mean, I don't know what else they could do to make it tougher on these buyers.
Yeah. Yeah. Well, I don't know. I think the buyers, this caught me by surprise. That was the one, and you know how I love making predictions, but that was what I didn't even see coming. That the lower listing commission amounts would be avoided by the buyers.
Man, they understand the value of having a good agent, and and I know that they want you guys to get paid too.
Well,
So
and actually, it's not that much more. 0.5% with the average price point that we're at in Jackson and Josephine County. It's not that much more. But anyway, that was a tangent. Sorry.
no, I know I'll pay it to have good
Well,
representation.
and I'm sorry, we got to go to another commercial break, but I want to talk to you about what lend you're doing as a lender for the commission problem. We'll be right back after a quick word from our sponsor. Well, hey, Southern Oregon, welcome back to the Real Estate Show. We're going to get on with our very interesting interview with Guy Giles of Mutual Mortgage in a quick second. I did just want to remind you briefly that this episode will air again tomorrow, Sunday at 8 a.m. on our new radio home, the ACE station 1300 AM. We're really enjoying being here. Our segments are more full bodied. We get a little extra time. And thank you to Pete and Joe for getting us on the ACE. Okay, Guy, we were just talking money and interest rates, and I had to cut you off because of the commercial break.
Yeah, well, we got the rates coming down a little bit, but at the end of the day, I just if you can afford it, I still think you should really get into a house. And I don't mean to keep beating that drum, but we also had some other data come out this week from CoreLogic that month over month houses had gone up 1.1%. Could you imagine if you annualized that and that kept up? I mean, we're only on pace year over year for about 5.3% appreciation. But if you're waiting to save up a down payment, which that's a good thing to have, don't get me wrong, but waiting to have that extra 5 or 10 or 20 thousand dollars in one year at 5.3%, you could lose what 20 little over $21,000 of appreciation by waiting to get in. And I say that to lead into I've been seeing some pretty reasonable mortgage insurance lately. So what some people are doing, they may have some consumer debt out there and they were thinking of
Uh-huh.
20% down. And, I'm, that's what my mom did. That's what my dad did. So I'm coming in with 20% down. But then they have, a couple of things over here that are financed that are costing them seven, eight, $900 a month.
Mm-hmm.
Pay those off and then come in with 15% down. You'll still get rid of that mortgage insurance once you pay the thing down, but it could really change the math on what your output is per month. And like I said, this mortgage insurance, if you have a decent credit score, if you have a poor one, then it's going to be what it is. But I've seen them as low as like in the $20-$25 range sometimes for a really
Wow.
good credit score with something that's kind of close to 20% down. But it's just good to come in and have that talk, and so we can do more mortgage planning. Then I found the house that I'm in love with, and then we're just scrambling to put your loan together real quick to get an offer out. And
Yeah,
so
that's kind of hard to do in today's environment, I would think.
and we're doing things fast. I mean, honestly, if you're not self-employed, we're getting your pre-qualification, ready to go, and
Right,
just
but you don't want to be scrambling when you're trying to write an offer.
no, no,
Is
no,
what I
no.
mean. Yeah. Yeah.
I I closed one last month. I think I had talked to you about it. I was struggling right at the end of the month. That one came to me with a contract, and turns out it was a bank statement loan and a self-employed person, and uh, we got it done. But it's definitely not the time to try to fix a credit score or scramble to figure out exactly how you're going to do something when you're trying to write an offer. So come in and see me a
Well,
little bit earlier.
and you were talking about the mortgage insurance, and I realized that one of the advantages of having Southern Oregon's better than the national average appreciation is that if you do have a loan that has mortgage insurance, you really should be checking every so many years, because you can probably have that removed sooner than later, as long as it wasn't an FHA loan.
Yeah, but before I got involved in this business, my mom had a loan with Bank of America, I guess, and she paid for years after it was down. I think automatically it drops off now at 78%, but
Oh,
but is all they're doing is they're tracking where your house was when you bought it, and then when you pay it down to there. So like you said, staying on top of it a little bit, and when you get to that point, maybe talking to your lender, maybe it costs you an appraisal. But if you can get rid of, some old mortgage insurance, it's $250 a month. It does not take very long to pay for an appraisal.
yeah, it was interesting because we've been doing construction loans in our personal life. And with COVID, the run up of appreciation was so shocking that the tax assessor like redid, well, I think they did everybody's tax, they do it all the time in Jackson County, but we got hit really hard. And we were very upset about it until I realized, oh, I bet we can take our mortgage insurance off.
Yeah.
And it kind of made up for that couple $200 or $300 a month in our bill. But you know,
No,
there's good and bad about your properties being worth more.
oh gosh. Well, yeah, and I guess 2020 was right before the COVID thing. And I mean, if my numbers are right, and you'd have to correct me if I'm wrong, I mean, I'm just getting these from national averages, not what's going on right here. 47% since 2020. That's huge.
Yeah, in some neighborhoods that is exactly right. Yeah.
I just
Yeah.
I just can't even believe it. We've actually done a couple of new things when you talked about doing construction loans and investments. We obviously have a great construction loan, but we
Well,
started doing,
let's hear about that.
well, I mean, it's just a one-time close. Actually, that wasn't where I was going with this. So let me
Oh,
shift.
I'm sorry, and I keep interrupting. How about you talk and I'll be quiet?
Not at all. We have a one-time close where you close up front, and then at the end of the whole construction, if rates are down, we just give you that lower rate. So one way or the other, you're
Oh,
going to
that's
get
nice.
the better of both worlds. And
Hmm.
go into construction loans and probably do a whole show on it. But one thing that we're doing right now, I've actually done a couple brokered loans, which have kind of strayed away from, historically, just because there's been enough normal stuff. But I've ended up just trying to help out some people that I know, so I've closed a few. And going through a broker, you're always at the mercy of them, you know. And we just brought the bank statement loans and what we call the DSCR loans in house. So we're doing them. We're doing them with our own underwriting, doing them ourselves, and
Oh,
losing
that's good.
control, yeah, or not losing control of that whole piece of it is just going to be nice. So we're actually expanding, you know,
Yay.
what we're doing actually ourselves. So and our construction loan, that's one that we're doing ourselves. Also, we're closing all that in our own name. So our
Wow, you guys really have expanded.
yeah, our little place that's been around for over 100 years is getting real serious about being one of the top lenders in the country. So,
Very
reverse
cool.
mortgage wise, we're already doing more than anybody in the country.
Wow.
But anyway, we're
So
just kind of plugging along.
Well, let's talk about getting your mortgage insurance removed because some people listening to this today may have purchased their house a couple years ago, before COVID, 10 years ago, and never thought to go back and check and see if they're over that 20 or 30% appreciation. What's the process? If somebody wants to call you up and say, what do I do here?
For me, I mean, if I was doing it, I would call up my real estate agent or call up Alice and say, could you do just a CMA, but current market analysis on my house? And
Uh-huh.
and you'll probably be pleasantly surprised, if you want to get cheered up a little bit, what your house is worth now. But I would do that before I went and paid for an appraisal. Um,
Okay.
Basically, call your servicer up. Don't pay for an appraisal yourself either way. No bank's gonna say, "Oh my gosh, you went and got your own appraisal. I'm so happy. Now we're gonna get rid of you." They'll want one of their approved appraisers to be out there. But call your servicer up after you find out what your house is worth. Find out exactly what you need to do. And I have actually seen it without an appraisal, but usually they do. They'll probably require one. So
Hmm.
they'll get it done, and legally they can't keep that on there if your house is worth more than so that you have that 20% in there.
Now, that's good for all the mortgage programs except FHA. And we have about a minute left till our next break. Can you just briefly say why FHA still keeps the insurance on there?
Oh, government's greedy. I mean, you want me to pick something up?
Well,
They,
that was to the point.
they started it because the program, they're worried about it being insolvent back, right after the crash, and they've left it the whole time. So they've made it a little bit easier. They've reduced the rates a little bit, and then with some down payments, you can get rid of it at some point on a FHA loan. But I don't have a better explanation than government likes money.
So what if somebody's in a stronger financial position and they want to get their and they have an FHA loan, can they refinance?
Absolutely, yeah.
Okay, let's talk
Sure.
about that in the next segment because we do have to take a quick commercial break.
Sounds good.
Okay, thank you to our sponsors. And also, if you'd like to be a guest on the real estate show, you can reach out to me directly, Alice Lema, John L. Scott Real Estate, 541-301-7980. We're also interested in saying thank you to John L. Scott, Ashland and Medford, Guy Giles, Mutual Mortgage, and ARVAR, our local Rogue Valley Association of Realtors. Well, hey, Southern Oregon, welcome back to the Real Estate Show. Thank you for joining us again. We're talking to Guy Giles from Mutual Mortgage. And right before the break, we were talking about mortgage insurance and how to have it taken off your loan. But if you have an FHA loan, that's not always possible. So what are some of the options, Guy?
Well, I mean, first of all, it's going to depend on your. A lot of people wanted to keep those rates that they had when they were, in the twos.
Oh, of course. Yeah.
So, it would make a whole lot of sense to just do something to try to get rid of your mortgage insurance and preserve that rate. So you can, like I said, you can call up your servicer, find out exactly what the process is. I would start with contacting, your agent or give Alice a call to do a current market analysis. Hopefully you don't get flooded with 1,000 of these next week, but
I can handle it.
uh,
Yeah, but we also have a lot of great agents. But if it's an FHA loan in particular, and I forgot about the lower interest rates. How do you run the numbers to decide
I,
mathematically if it's worth it?
well, I always take everything to the end of the term. I mean, if you're just getting rid of mortgage insurance, it's going to be worth it. I mean, as far as like me running the numbers, I mean, it's going to be a best guess. I mean, the fun thing would be for somebody to do a current market analysis on your house, and then somebody discounts their house between the time the appraiser comes out. So it's never going to be an exact science, but at least you can get a good idea. Are you close to that? So it's always going to be a good thing to get rid of the mortgage insurance if you can. That's just
Mhm.
insurance you're paying to cover the lender in case you default. So that's not something that you want to have if you don't have to. But as far as refinancing to get out of it, at that point, I just like to do the math. You'll get the Quicken Loans of the world and the Rocket Mortgages that'll call you up and say, "I can save you $500 a month," and probably they can if you're just looking on a short term, but I like to look at it, all the way to the end of your loan. And if you're not going to, I mean, if you have to start that amortization all over again, you want to look at the whole thing, rather than just, hey, I lowered my payment, $500, which might be super important to somebody right now if they're in some kind of financial trouble. But you really want to look, if you're 8, 10 years into a mortgage, you're starting that amortization over again, and you always pay most of your interest up front because banks and lenders have figured out if they amortize these out like this, most people are not in their loan for 30 years. Once you get to that point where
Yeah.
you're starting to, as you progress through that loan, you pay more principal reduction every month. So it's just, when you're making that decision, you want to have, a mortgage lender that will sit down with you and take the time to look at the overall picture. Because if you could, kind of just get laser focused and pay that debt down rather than redoing your whole loan, you're probably going to be better off in the long run. And I'm never that guy that's going to try to make a quick buck to refinance you if it doesn't make the most financial sense.
So there's an interesting kind of counterintuitiveness at play here with the higher rates uh, for people who are thinking of refinancing. And if you have a lot of equity and you have mortgage insurance, but you're in an FHA loan, which will not let you take the mortgage insurance off, you have to actually convert to a different loan program, which means that does that mean a refinance?
Yeah,
And
yeah,
okay,
yeah.
but so then your payment could be different.
Well, yeah, I mean, and again, I mean, it's really going to boil down to, obviously what your rate was when you started it. But I mean, usually when I put somebody into an FHA loan, I do it because of a FICO score, and they don't have
Right. It's because they don't have other choices,
nine
right?
times out of 10.
Yeah. Yeah.
There are lenders around that will put you in an FHA loan, even if you have 15, 20% down and a good FICO score, and
Oh,
they look you right in the eye and they will say, "Oh, it's okay. We're going to refinance you in 6 months anyway." Then they put you in their calendar to refinance in 6 months, and they've gotten two loans. So I cannot tell you how many times I've sat down with somebody and legitimately looked them in the eye and said, "I think I'm missing something because I do not know why that lender you got pre-qualified with is putting you in an FHA loan. This doesn't make
mm-hmm.
sense." And they said, "Oh,
Mm-hmm.
it's not forever. We're going to refinance it." And I'm like, "Well, that's great.
Well, but see, now look at how the world is.
I know.
Now look where we are.
But
Uh,
but but to get somebody in the right lane, I mean, to be fair, I'm putting people in loans right now, and I'm hoping that they refinance, at some point because
we all are for
yeah, I'm hoping
sure.
the rates go down. But I'm not doing that. I actually lost some realtor business with these 3-2-1 buy downs when they came out because everybody was wanting me to sell the heck out of them, and I would do them if somebody wanted one, but I never actually ended up doing one. And guess what? People are on their second adjustment at this point, soon to be on their third adjustment, where they're going to be paying a percentage and a half more than what I got them into. the agents, so most of them, the credible ones that I've worked with for a long time that really understand this stuff, we bought down their rate to begin with. And it maybe wasn't quite as big as low as that buy down, but they're not having those crazy adjustments right now. And I can say that I didn't do one of those things.
Well, and
And
it is causing some stress in some households that the interest rates are so high and they weren't really planning on that happening so soon.
well,
Or the rates being that high. So yeah, there is some drama going around with those programs.
and I'm not blaming people that got people into those or whatever, because there's not one of us didn't think rates would be down by now. And when I talk about one of those, there were these buy downs where you could have a 2% lower rate for the first year, a 1% lower rate for the next year, and then on the third year it went up to your regular rate. And those people thought they would have an opportunity to refinance out of those by now.
Hmm.
And
Well, and the rates went up higher, faster
yeah,
than anybody told us was even possible. Because do you remember the feds back in the day? They were saying, oh, like five. I
yeah,
remember hearing five a lot, not 7.5.
I remember actually saying 5.5% by about this time this year, or maybe in the next month or two. But all the
Hmm.
projections were that.
Yeah.
All this inflation was supposed to be transitory, but you can't print money forever. I mean,
Hmm.
apparently you can, but it doesn't help in the long run. But anyway, I'm feeling a little bit more sanity coming, and that's my hope, because I just want for the next generation to have what I have the ability to
Yes, me too.
do what I did, and that's all. I mean, I have mine. Let's just be honest. I'm okay. But I want that for the young people coming in. I want that for the older people that have never been able to buy a house and generate wealth like that.
Or older people who don't have great retirement, or middle-aged people who don't have great retirement. Real estate is one of the asset classes you should consider.
Well, and it's if you just sit down and do the math, your rents go up. I mean, manufactured parks, they go up. They go up for just regular people, if they're just actually renting a house, and that will catch up to, I mean, shoot, my parents when I was growing up were paying $650 rent for a three-bedroom, two-bathroom house, and it probably felt like, man, what a stretch to go buy a house, because we did not own a house the whole time I was ever growing up. My family.
Really, that always surprises me every time you tell that story. I always forget that.
Oh man. And if you look, if they would have just bought a house back then and say, oh my gosh, $850 for a payment if I bought my house. Think about where they'd be sitting right now. Well, the house would be paid off, but you know what I mean.
Hmm.
It's just the rents go up an average of probably 7 to 10% per year, especially with inflation where it is right now. You're buffered on your house from that payment ever going up, other than your taxes and insurance a little bit.
Hmm.
You don't think that landlord's factoring that into your rent increases, you're crazy. So you are actually paying those things anyway.
Well, and in Oregon, because we're a rent controlled state, the whole state is rent controlled. The landlords have to be building in pretty much annual increases of some type, because you can't get caught up again. It's not like it used to be. I mean, you can get caught up if somebody moves out, but if you have great tenants, and that's what we all want, and tenants like that stability too, then it's a real teeter totter between staying in with inflation, not losing a great renter, but also staying up with the market, the rental market. It's tough. It's tough for everybody.
Have you seen rents like get cheaper for people since the rent control thing started?
No, they've gone up, but also there's, the side effect of just Oregon in general doesn't have a lot of available development land. Our state has probably fewer acres statewide than most of the rest of the country, but that's a different conversation. And
Bottom
we
line,
only have a few seconds left, and we want people to know your phone number and your email. Guy Giles, Mutual Mortgage.
call me at 541-944-6987, or you can Google me. It's ggiles at mutualmortgage.com.
And he does answer his phone. And if he can't answer, he will text you, right?
I will get right back to you, and I hate texting, so I will call you right back.
But you will get a
I'll
text.
text you and let you know that I got your call. Yes.
Yeah, yeah. Well, Guy Giles, thank you so much for all the great information this week.
Thank you very much for having me on.
All right, folks, have a beautiful Southern Oregon weekend. We'll see you next time. Bye now.